Welcome, everybody. Glad to be with you again. And today I'd like to talk to you about Fibonacci. This is a tool, a couple of different Fibonacci tools actually that have served me very well over the years, and I'd like to share those with you today. As Renee said, I'm Vince Vora, I'm the head trader here at Trading Winds, and I have been doing this for a little over 30 years. Throughout that time, I've developed several strategies and trading systems. I'm actually going to share one of those with you today, along with the Fibonacci tools. But please do remember that trading can be risky. So please don't trade with real money until you are completely comfortable with the system that you are using. Now, in today's presentation, I will start out by sharing with you the layout and all the rules, the full winning momentum strategy that we use at Trading Winds on a very regular basis. And then on the back of that, I will share with you how we use the Fibonacci Retracement Tool as well as the extension tool. I think these tools will make any strategy that you're using much more effective, but I'll use our winning momentum strategy to demonstrate that for you. Today, of course, if you have questions along the way, by all means, type them in, and I will try to get to as many of them as I can by the end of our time together today. Now, when it comes to Fibonacci numbers, I'm sure most of you are familiar with them, but in case you're not, these are numbers or ratios that are mathematically significant. I like to say I really don't know much about them. What I do know is that they work, and they work effectively, not just in trading, but in many parts of life, but certainly in financial markets. They were discovered by Leonardo da Pisa in the 13th century. He was a very talented mathematician, and probably the most commonly used and the most important one is the 61.8% level. I'm going to explain these as we go through it. I prefer to use the 38.2, the 50, and the 61.8, and actually I like to use that as a zone rather than individual levels. Again, I'll demonstrate all of this on the chart. But the main reason for using Fibonacci numbers is to help you identify significant areas of support or resistance. And more importantly, to help you identify where future levels of support and resistance will be, especially if you're trading with an instrument that for example, is at an all-time high. Well, if it continues to go higher, how can you tell where you're going to run into a potential level of support or resistance if the stock has never been there before? There's never been any price action above the level where it is now. So it's impossible to tell without using Fibonacci numbers, and that's why they are as handy as they are. But let me bring up my charts here. I'm using my TOS platform today, and let's talk about, first of all, what you should be trading, what types of charts you should focus on. And then once I lay out the strategy for you, we'll incorporate the Fibonacci tools, okay? So first of all, what you do want to try to do is always trade with two things in your favor. That is trend and momentum, okay? And I'll explain how to read those in just a moment. But when you're trading a chart that is clearly trending in one direction or another, and it's very easy to spot if you're comparing them, the odds are so much more in your favor for a successful trade. And let me give you an example. If you look here at a Biomed, ABMD, it's really tough to argue anything other than to say that this is going higher, right? This has slowly but surely been trending higher. Okay, clearly a nice strong trend. And what I like about the price action is the fact that the candles are very similar in size for most of the ride up here, and they're made up of mostly bodies, very few wicks and tails, which is very important when you're looking at price action. But if you have a look at something like TMUS here, T-Mobile, have a look at that and compare it to a Biomed. This one is all over the place. The candles are all different sizes. There's a lot of wicks and tails, and there really is no trend here. It's one big chop zone. We're moving back and forth, back and forth. And the reason why it's so risky to trade a chart like this is because no matter what strategy you are using, A, it's very unpredictable, very difficult to predict the next move here. And B, no matter where you try to get in, your likelihood of getting stopped out is extremely high compared to something like a biomed, which has been very predictable, very easy to read, and not a whole lot of fluctuation. So no matter where you get in here, your chances of getting stopped out are slim. Okay, so, but we're not going to rely on just the price action. We're going to throw some indicators on, and we're going to start with a very simple one, a very common one, which I'm sure many of you have either seen or have used in the past, and it's a simple moving average. We are going to throw on the 20-period simple moving average. I prefer to use the 20. First of all, it is probably the most widely used by both professionals and retail traders such as you and me here, but it is extremely effective for judging momentum. That's what we use in order to judge momentum. So here, this blue line is the 20-period simple moving average, okay? And what we want to look at when we're trying to judge momentum is there's a couple of different ways of doing it. One, you can just look at the slope of the price bars, right? So obviously an area like this has momentum higher. And when it comes to momentum, you know, there's different degrees of momentum. What you want to focus on is the areas with the highest amount of momentum, right? The most significant slope on price and on that moving average. Now, that moving average does a very good job of drawing in the type of slope that there is on the price bars at the moment, right? But more effectively, what it does is that whenever there's a retracement throughout a trend, like we see here, okay, if we didn't use the moving average, all we could do is draw a line across the price bars, just like we do when they're sloping higher. So if we were at this point in the chart, we didn't see anything in the future, and it started to slope with this kind of degree lower, we could easily think that that's the start of a move lower. When you have the moving average here, and it pulls back, and the moving average does not change, in other words, it maintains its slope higher, that makes it very clear that more often than not, this is just a retracement before a continuation of that move. So what we want to do as it's pulling back towards that 20 that maintains its slope is start looking for signs of a reversal. And I'll tell you exactly how we do that in just a moment. But right now, all you need to focus on is the fact that the blue line here is a 20-period simple moving average. And what we want to do is have a significant slope in the direction that we are trading. Okay, so if we're looking to go long, we want the 20 to slope significantly upward. If we're going to go short, we want a significant downward slope on that 20. Now, the second thing we want aside from momentum is trend. And for that, we are going to use an indicator that is known as the Ichimoku Kinko Hyo indicator. Now, on TOS, they just have it as Ichimoku here. On the street, it's really known as the cloud indicator. Now, I'm going to go into the settings here to show you that the default settings on any platform are usually 9 and 26. We are not going to change that. We are going to keep the default settings. But with this indicator, there are usually 5 portions to this indicator. I'll show you by throwing it on the chart. Okay, there you go. So there's 3 of these lines that are actually moving averages, but they're calculated a little differently. And there's this shaded area, the cloud, which right now it's shaded in yellow because it's strictly been an uptrend. But when there's a downtrend, it's shaded in pink. So what we want, though, is we only want this indicator to help us identify trends. So what we need is just the shaded area. So what I like to do is go into settings and remove the other 3 lines. So the shaded area is the span A and span B. What we want to do is highlight the Tenkan, the Kijin, and the Chico and make them disappear. So the way we do it on TOS is to click on the tab and uncheck Show Plot. Click on Kijun and uncheck Show Plot. Click on Chico and uncheck Show Plot. If you're on a different type of charting platform, there's either a way to make these invisible, or a simple thing to do is to go and change the color of that particular tab to the same color as the background of your chart, and that'll make them disappear. So in the end, what you want to end up with is just a shaded cloud area here. Now, the way we use this for trend is that whenever price and the moving average are clearly above the cloud, we consider that an uptrend. When both price and the moving average are below the cloud, we consider that a downtrend. And when one or both are overlapping the cloud, that's a consolidating area, and we do not want to use this strategy during that time. Okay? So now, with these two tools, whenever you bring up a chart, your first reaction is to look at the far right, look at the most recent candle. And within a split second, you should be able to tell whether or not there is a trend and what it is, and whether or not there's momentum behind that trend. So if we were to look at a biomed right now, we can quickly say that price and the moving average are above the cloud. So we say we're in an uptrend. Secondly, we'd be looking for momentum to support that uptrend. In other words, an upward slope on that 20. But right now we don't have that. The slope on the 20 is actually pointing downwards. So if we were looking for trades, we would pass on this chart today. We would look past it, okay? Because we only have one of the two things we want. We only have trend. We don't have trend and momentum, okay? So let's see if we can find something that does have both. Okay, well, let's look at the Qs. The Qs, price and the moving average, are above the cloud, and we do have a slope. Now, it'd be better to have this degree of slope, but there's still an upward slope on that 20. So now we can say we have trend and momentum. So let's now go to the third and final component here, which is the relative strength index, otherwise known as the RSI. Now, this is an indicator, and I'm going to throw it on the way it normally is. Hope you can see it well. That is usually used to identify overbought and oversold conditions. So aside from this line that you see bouncing back and forth, there's these two horizontal lines, one at the 70 level and one at the 30 level. And normally, if this line were to be above the 70 level, that would be considered an overbought condition, and you would expect the stock to pull back soon afterwards. Or if the line dropped below 30, that would be oversold, and you would expect some kind of rally. We're not going to use that right now. The way we use this is actually, first of all, we're going to change the default setting. Usually the default setting is 14. We're going to cut that in half. We want a much more responsive RSI. Secondly, we are going to use one of these overbought and oversold levels, and in this case, I'm going to use overbought, and I'm going to move it from 70 to 50. Okay? Move that to 50, and then the oversold, I'm going to go into the tab here and just get rid of it completely. So now, what we end up with, let me just change the color here and thicken it up a little. What we end up with is a 7-period RSI with a line drawn right down the middle at the 50 level. Okay? So it's a 7-period RSI with a line drawn down the middle at the 50 level. And this is what we are going to use to identify our entry candle or our setup candle. So right now, if you see here, there is no setup. And let me explain why. Let me go back and show you an example back in here or in here. There's several of them on this chart. Whenever you have an upward slope on the 20-period moving average and you're clearly above the cloud with both price and moving average, you have those two conditions, a trend and momentum in your favor. So what you look for is the start of a retracement towards that 20-period moving average. When you start seeing the stock pulling back, and by the way, I say stock, but it can be any instrument. It can be a Forex pair. It could be a futures contract, a stock. It could be an ETF. It could be anything, and on any time frame. This works across the board, okay? But when you see this pullback begin, you need to turn your attention to the RSI. And what you want to see for a long trade is a move, a cross from below that 50 line back to above the 50 line. And you want to identify the candle associated with that cross. So if I zoom in to this area, have a look at my crosshairs. When I hover over this red candle, you can see that down here, the RSI is below that 50 line. But if I move over to the green candle, you can see now the RSI is back above that 50 line. That means that this green candle is our setup candle. So we want to highlight that. And now, for the trigger to actually get in the trade, we want to make sure that there is a trade at least 1 tick or 1 penny above the high of that setup candle. We want to confirm that there's follow through, right? That the move is continuing to the upside. So we want to wait for a trade 1 tick or 1 penny above. If we get that, we go long and we put our stop just below the most recent low. So the key here is to identify trades with the highest degree of slope on that 20 period moving average and the least amount of risk. You can control this. You can decide which trades you take and which trades you do not. So always look for something that has a very small amount of risk. In other words, a very tight space between the entry and your stop level. Okay? Because in the long run, what you should experience is more winners than losers, but your winners should be a lot bigger than your losers. So if you keep your risk very small and you only trade the ones that have very strong trend and very strong momentum behind it, you'll do extremely well. Okay? So just to recap, you're looking for trend, meaning price and moving average above the cloud. You're looking for slope on that 20 in the direction of your trade so that you have momentum. And you're trying to identify the candle associated with the cross from below to above that 50 line on the RSI. Once you see that, you mark the high. If you get a trade above that high, you go long, and your stop goes just below the most recent lows. Okay. Now, you'll see trades all over the place. There's another one back in here. Whenever you see a gap, I would caution you on taking that trade. And even though some work out very well, the reason why I don't like gaps is because, remember, you have to mark the high of the setup bar, which in this case would have been this green candle, and your stop goes just below the most recent low. So see the degree of risk? When you have a gap, it increases, right? Because your stop doesn't change, okay? So you've got to be comfortable with that level of risk. What you want to do when you're selecting trades, okay, you want to go with the smallest amount of risk and the highest degree of slope. Okay. Now, for short trades, it's exactly the opposite. You want to look for a downtrend. How do we interpret a downtrend? Well, when price and moving average are below the cloud, that's a downtrend. What is downward momentum? Well, when the 20 period moving average is sloping downward. So when we have trend and momentum to the downside, then all we need to do is wait for some type of retracement back towards that downsloping 20, and then turn our attention to the RSI. And in this case, we want the RSI to go from above to below that 50 line. So the candle associated with that cross from above to below is our setup candle. And then we mark the low of that candle and wait for a trade 1 tick or 1 penny below that low. If we get it, we go short, and the stop goes just above the most recent high. Again, when there's a gap, there's going to be more risk associated with this. So you want the ones with little to no gap, just like in here. This one, your entry would be here, your stop would be here. It's less risk. Okay? And as long as you have momentum behind the move, it usually works out very, very well. Okay. Now, it doesn't matter where that setup candle appears. The setup candle can be in front of the moving average. It can overlap the moving average. It can be behind the moving average. What matters at the time that you identify that candle is that you still have the same degree of slope. Because when the stock pulls back too far, okay, that moving average will flatten out and start going in the opposite direction. So if the moving average has flattened out, you do not want to take that trade. You see over here, there was another cross. There was another setup right in here. But at this point, the moving average was completely flat. Okay? So we'd prefer not to take that trade. Now, many times it still works out. But unless you're a very aggressive trader, I would skip those and only stick with the ones where the odds are fully stacked in your favor. Okay? So that's the rules. Those are the rules for the short side. Now, as far as an exit strategy, there are many. In the class, the pro class that we have for this, we teach 6 different ones because everyone's got a different style. So we want to give everyone an option, something that'll suit their style. But very simply, you can either wait for a close on the other side of the moving average. You can follow it a little more tightly with a tighter moving average, like an 8 EMA, for example, okay, and wait for a cross on the other side of the 8 EMA. You could use a 2-bar trailing stop, right, where once you're in this trade, you look back 2 bars and put the stop at the high of the second last bar. Or if it's a long trade, it would go at the low of 2 bars behind you, right? And you keep trailing it every 2 bars. But we'll explain a lot more of that in the pro class. The question is, first of all, is the strategy effective? And I can show you many instances where it is. And in fact, I'll show you a couple other things before we incorporate the fibs, which is another way to make this even better. Okay. Let's look at crude oil. And I want to go back to a weekly chart here when crude oil was trading over $100. Back up in here. Okay. Remember, it was trading over 100, then it dropped to 40, then it went to 26 before starting to come back. Well, one thing I want you to pay attention to when you have these indicators on your chart is when price crosses from one side of the cloud to the other. If it does so with a significant slope on that 20-period moving average, there's usually a bigger move about to happen in that direction. So when you cross from one side to the other with slope on the 20 already in place, in other words, there's already momentum there, okay, that usually leads to a much bigger move. Now, the nice thing is that when it crosses, if that move doesn't happen, usually you don't get any setups. If it fails, it usually fails very quickly. Okay. Now, it's not 100%. There will be times where it fakes you out. But again, if you're focusing on the trades that only have slope on the 20, that'll eliminate most of the trades where you'll get chopped out, right? And if you do take a loss, it'll usually be much smaller than your wins anyway. But keep an eye on this. No matter what chart you flip through, okay? And let's look at gold now. Usually, and if we go back in here, let's look at the monthly. Okay? We don't have enough data there. Let's go back and see. Maybe gold's not a great example. Right here, look at that move. From one side to the other, right, on the daily chart with slope, right? You get it here to the opposite side, right? So you get it here. And the higher the degree of slope on that 20, the bigger the move usually is, right? And then once you see that it is in place, so when price and moving average cross, they're both below the cloud, that means a downtrend. You have a slope downward, that's the momentum. You wait for that retracement, and you wait for that RSI to pop above the 50 and then move back, and that's your sign to get in. If it goes flat, you don't take that trade. You wait for another retracement, right? This instance, it failed to get above that 50 line. So this would not have been a valid trigger. Don't fall into the trap of saying, well, this is close enough. There's no need. There are going to be so many of these setups that you're going to use on any given night or any given, whatever time period you're training. If you're training on a 5-minute time frame, throughout the day, you're going to see so many setups, you're going to have to compare one to the other and just select the strongest one, right? So don't fall into the trap of saying that's close enough. Don't worry about it. There'll be plenty of others. All right. Now, let's go back to the cues here and look at some of these trades. And then if you have symbols you want me to look at, I'll be happy to do that if there's time. But let's talk about the Fibonacci's. If we bring in the Fibonacci's, there's a couple of tools that can immediately improve your success rate with this strategy or any other for that matter. One is the Fibonacci Retracement Tool. Okay. Again, both the Fibonacci Retracement Tool and the Fibonacci Extension Tool, they will both help you identify areas of support and resistance. Okay. But we use the Retracement Tool to confirm our entries, and we use our extension tools to set our upside or downside targets. Okay. So we're going to start with the retracements. And we're going to go back to this trade in here. Okay. Whenever you use your retracement tool, what you want to look for, okay, once you identify your setup, so this candle here was our setup, you want to look back to your left and identify the most recent low and the most recent high. Okay. That's what you want to identify, the most recent low and high. You want to take your Fib retracement tool, and maybe I should zoom in here so you'll see it a little clearer. There it is. So you want to take your retracement tool, click on the low, drag it over, and click on the high. Okay. Now, remember at the beginning, I had said, I'm going to zoom in a little more here so we can see the numbers. There they are. I told you that I use the 38.2%, the 50%, and the 61.8% levels as a zone. So I'm going to color that in for you. Now, each one of those levels is a level of support and resistance, okay? But I like to look at it as a zone. And the reason why this is effective is because when you're in an uptrend and you get a slight retracement back and it comes back to an area where there is significant support, and that's what this zone is highlighting for you, an area of support, and you get a bounce off of that area, that usually leads to a much stronger move. So although we have the 20-period moving average, we have the Ichimoku cloud, and we have the RSI giving us a signal that we're likely to move higher, having the support here is just stacking the odds in our favor, okay? It's making the setup even more conservative, okay? Even more likely to be successful. And there's two reasons why this is positive. Number one, if it comes in here and bounces right off that level, that confirms that this is, in fact, a significant level of support. And so that bodes well for the long position. But let's say that we bounce here, we go long, and the trade quickly turns around on us, right? Well, we know there's significant support here. So if it turns around on us, it's most likely to at least stall here instead of just zoom right through, right? Because there's support there, it'll stall, giving us time to get out of that trade at a break even or maybe a small loss, right? So it really improves your odds of success in the long run if you use it that way. So that's the retracement tool. Now, on Thinkorswim, all you do when you're plotting it for a long trade is you identify the most recent low and the high, and you just click on low and then click on high. Okay, it's the opposite for short trades. For a short trade like this, you identify the most recent high and low, and you click on the high first and then the low. Okay, now if I zoom in here, you'll see that price came Let me highlight that area of 61.8 to 38.2 here. And you can see that it came here, hit it, and bounced. Now, it can go anywhere within this blue shaded area, right? That's fine. But the fact that it hit it and bounced is very, very positive. Okay. And so you just go from the high to the low and you plot that. Okay. Now, going back to that long trade, once we're in that trade here, let's zoom back in. Once we go along here, and we want an idea of how far it can run, that's where the extension tool comes in, right? The extension tool we're going to use, and we're going to use the same low and high that we use to plot the retracement tool. This time, instead of highlighting support behind our entry, it's going to highlight some upside targets. Because normally, one of the things you could easily do if you're taking a trade like this is look to your left, and if there's a previous higher low up in here, you know, price can usually moves into that level and runs into resistance. But if there's nothing there, okay, if we were at an all-time high at this point, which we were, there's nothing up ahead, the extension tool is the perfect tool to use to identify those targets. So I'm going to get rid of these drawings. I'm going to take our extension tool, and I'm going to go to the same low here to the high, click there. The extension requires one more step. We have to go back to the low and click there again. So you click low, high, and back to low. And these are your upside targets. So there's the 100% level. So once you come down and you bounce, most likely you go there. If you blow through that level, you go to the 127.7 or 0.2, excuse me, extension. And then there's the 1618 extension. Eventually the 2618. Okay. So you see how beautifully this works, right? You come in here, you go to these levels, you pause a little, you hit there, you pause a little, you come back. Sometimes you come back right to the other level, hit it and bounce again. And whenever you clear one of the levels, your next target is that next line. So once we cleared the 1618, we go up here. Okay. Now, you can use this to scale out of a trade. You know, you could just stay in the trade until you close on the other side of the moving average, or to improve your odds of success in the long run, what you can do is use these levels to start scaling out and moving up your stop. So in other words, if we started off with our stop just below this low here, because our entry was over here, right? We now, once we hit that 1272 extension, we'll take a third of our position off, and we move our stop from here to here, which is break even. Now, you know, unless there's a gap against us, we have no more risk on that trade. Now, once it hits the 1618, we take another third off, and we move our stop just below the next level. Now, our worst case scenario is getting stopped out for more profit, right? And we've already banked profits twice. Once it goes up here, we just take the final third off, right? And move on to the next trade. Many different ways you can do it. But it's very, very effective. Works exactly the same way to the downside. Okay? So remember, this was our trade. This was the high and low we were using. Let me clear this off. Let's take our Fib extension tool. Let's zoom in here. Let's take our high to low, go back to high, and there are our targets, our 127, our 1618. Now, this one, I don't know if we've eventually hit the 2618, probably not. But anyway, we would have been stopped out before then. So we'd have taken a third here, and then if we were shooting for the final third here, when it turned around and came back, we would have been stopped out at this level again, right? So either way, would have been a very effective trade. Okay? And these are very, very handy tools. And these levels will remain support and resistance levels in the future. You can see by price how they move into it and bounce off it, bounce off it, bounce off it, come in here, bounce off. You know, they're very, very effective levels. Like I said at the beginning, I don't know exactly why they work, but I do know from experience that they do work, and they work very effectively. So I encourage you to use them. Okay. Now, let me share with you, there's one trade looking like it's setting up here, and that is Nike. You look at Nike on the daily time frame. First of all, there's a pretty clean chart. It's trending strongly in one direction. Not only that, it's doing so on multiple time frames. You look at the weekly, you look at the monthly, right? They both have clean trends and very strong slope. So it confirms what you're seeing on the daily. We have an uptrend. We have solid momentum behind it. We're pulling back towards that 20. And now today, you can see that we're moving from below to above. Now, this is a daily chart, so we've got to wait till the close today. But if it closes above that 50 line, today's candle will be the setup candle. Okay. Now, it's also important that we close somewhere near the high. That usually leads to an immediate follow through. Okay. But if we close like this today, all we have to do is mark the high for Nike. Okay. And one trader, one ticker, 1 penny above, we can go long. Now, this is a classic example for the fibs, right? Where upside targets. This is an all-time high, right? So obviously, there's one at 81, which not much resistance, but might act as some resistance. But we can plot the fibs and know exactly where we're going, right? Now, whenever there's gaps, it makes it a little more difficult sometimes, but you'll get used to these, and you can always take the major low and the major high and plot your fibs. Okay, very simple, very clean, very easy, and usually very, very effective. Okay, and it works on all time frames. So again, it doesn't have to be on a daily. If you're managing a longer term account, like a retirement account, you don't have to spend a lot of time on this. You can do this once a month or once a week, and use the same concept, right? Once you have a clear trend in one direction, and you have momentum behind that move, you just wait for a bit of a retracement towards that 20. And when you get across, that's your setup candle, and you go from there. Now, this pattern itself is one other thing I want to tell you about. Whenever you get a dip across and then an immediate pullback and another cross, that's what we call a double dip. It'll look like the letter W for a long trade. It'll look like the letter M for a short trade. Very, very effective. They usually lead to big, big moves. Okay. And it doesn't matter, like if you look in here, right, where that first cross happened, here, okay, you can see that we did trade slightly above there. Right? If I mark that high, on the next candle, we did trade above it, but we never did breach the low, right? So we were never stopped out. And then on the next run, it went through, okay? But sometimes it won't even trigger, and on your next cross, you'll get the trigger. Or sometimes it may even stop you out, but then trigger you back into the trade. Either way, the loss here would be much, much smaller than the gain. And you don't have to catch it all. You just need a portion of that move, okay? So very, very effective. And then throughout any pullbacks, any pullbacks, as long as they're slow, would be another opportunity. And incorporate your fibs. Always incorporate your fibs in there, both from the buy side and the sell side. Even if we were to just use here, once we got in here, go back and use the previous low and high for our extension targets. Here, low to high to low. You can see we would have easily hit these targets along the way. So even just using, those first three to scale out, real nice profits in there. So very, very simple. Okay. Any time frame, any market, any time period. Look at the USD CAD. Let's look at a 1 minute. Who trades Forex, right? On a 1 minute chart, USD CAD, right? Once it's trending, any of these pullbacks, there are those crosses. Don't take my word for it. Go back in time, look at these crosses. Look when you have slope, clean trend, cross of the RSI. It's very, very simple, very effective, and use your fibs, right? Here, take the recent low and high to low, and there it is. It gets back right to that zone, bounces off it, and flushes. Very clean, very simple, okay? Now, can we make it even better? Well, let's have a look. Let me show you. We've got a pro class. If you go to tradingwinds.com/fibs, F-I-B-S, short form for Fibonacci, tradingwinds.com/fibs, we've got an on-demand pro training class for you where we offer everything that I taught you today in more detail, a lot more examples. We also will cover the 6 different Fibonacci tools. So not just those 2, we go through the retracements, the extensions, the fans, the spirals, the Fibonacci arcs, and the Fibonacci time series. All very effective tools for identifying support and resistance. So again, it doesn't matter whether you're planning to use the winning momentum strategy or not. You can use any strategy. These 6 Fibonacci tools will serve you very, very well. I'm also going to reveal during that class the specific fib levels that I've only used some pro traders use, okay? These are very, very effective. You know how many times you will see a trade setup, okay? You'll put your stop nearby. Your stop will get triggered, but then the stock just takes off from there, okay? Many times, those stops get taken out near these levels where the pros look for fib levels. So I'll explain all of that in that class. I'll show you a different way to combine the RSI with Fibonacci to find even more powerful trades. And I'll teach you a manual method of identifying the most significant areas of support and resistance so that when you put those hand in hand with the Fibonacci's, they're super, super reliable, those levels. I'll teach you that. As a bonus, we'll throw in a 30-day trial membership to our Trading Winds Pro service, which includes nightly videos from myself every Sunday to Thursday. I will send you videos after market close, recapping what happened in the markets that day, and that's also where I share my trade ideas. We also have live market chats. We had one this morning with our pro members. We meet twice a week, once every Monday evening and every Thursday morning. You can come into our room, ask me any trading related question you like. And also for our members, we do what we call a course of the month every month. That's part of your membership. No extra charge there at all. So you'll get that course as well for the upcoming month. All of this for just $3. We wanted to make it a no-brainer for you. Obviously, this isn't a moneymaker for us. We just want you to see what we do here at Trading Winds. At tradingwinds.com/fibs. And you get all of this for $3. Terrence, we do look at some Forex trading. It's not our main focus. Our main focus is on equities. But again, there's a 30-day trial thrown in with the $3 here. If you're not happy with it, cancel it at any time throughout the 30 days. You get those 30 days all included for the $3. So you might as well give it a shot and see if it's useful for you or not. I promise you the live market chats. We have great members that help each other out. A lot of info. Our course of the month is a great value. And this course here, there's a ton of content in this Fibonacci course and very useful no matter what strategy you use. So I hope you enjoy it. Again, it's tradingwinds.com/fibs. Thank you very much, everybody. I'm out of time.